On the SBS On The Money podcast, the Australian share market back in the 2025 black. We take a closer look at what US companies are saying about how US import tariffs are hitting them, and retail sales are soft. What does it mean for interest rates? All of that and more next. Hi everyone, it's a daily 10-minute business and finance news wrap for this. The Australian share market up 1.13% on the S&P ASX 200 at 8,238. It means the local market is now in the black for 2025. So since the beginning of January, the ASX 200 is up 0.45% despite all the volatility we've seen. Granted, though, it is still 3.7% down from the February record high, but today marks 7 straight sessions of gains. So what's happening on the market and where to next? For that and more, I spoke with the Chief Investment Officer at Blackmore Capital, Marcus Bogdan.
The recovery has been stunning since the early part of April. And as you said, we've had a week of constant gains. I think it all started when the US administration paused the reciprocal tariffs for 90 days, and that gave the market a great deal of comfort that some negotiation could occur. And then the first lot of results that we've seen in the US, particularly in the banking sector and some of the technology stocks, have also been stronger than anticipated, and that's supported our market. And then obviously today, if there is a connection between China and the US administration to begin the talks on those really incredibly high tariffs, that would be encouraging. However, I would note that none of the agreements have been signed, even with the closest allies such as India or Japan. And we're very much still at the foothills of any discussions with China. So in some respects, I think there's an inevitability when markets get sold off so dramatically that you will see a recovery on slightly better sentiment and better news. But there's still so much to be unresolved.
Still, today marks a day when all the losses made so far this year have now turned around. The market's now up for 2025 as of today. So where are investors buying? I mean, one interesting thing that I've noticed is that the Commonwealth Bank again touched a record high. In other words, is it just defensives or is it across the board?
Well, as you look across the last month or so, it certainly was the the Australian domestic oriented companies that were more defensive in nature, that they weren't the front line of companies that are going to be affected by tariffs. They have been incredibly strong. Today, though, two of the laggards of last month have done very, very well, and that's been the energy sector, which has been very depressed because of just the potential impact of global economic growth is not good for the oil price. And secondly, healthcare has also recovered strongly today, and that's also been caught up with the potential of tariffs on pharmaceuticals coming into the US, particularly affecting CSL. But as you've rightly have said, the share price of CBA has been absolutely stunning. It's gone back to a record PE of around 26 times. It trades at a 79% premium to the other banks, and that's despite probably very low single-digit economic growth. And one further stat on CBA is that CBA now is the 6th largest bank in the world based on market capitalisation. And given the size of Australia, that is a stunning result for CBA.
You mentioned a few moments ago tech earnings results. We heard from Apple and Amazon overnight. But while the numbers, the profit numbers and the earnings numbers aren't too bad, right? I think investors are really looking to the outlook statements, if I'm not wrong. What are companies, though, saying about the impact of tariffs?
Well, there have been divergences there, but certainly in the case of both Amazon and Apple, they did raise concerns, Apple, particularly on additional costs that they would have to absorb. I think they're around $900 million for the rest of the quarter. And Amazon, given that a quarter of the items that they sell globally are sourced from China, they're very concerned of what that's going to occur in terms of price increases. So those results are sort of backward looking at the March quarter, but there is definitely concern both on rising costs and slower consumer demand. And we've seen that more broadly with Australian companies reporting that are facing into the US. So in the last week, we've had Brambles that have indicated a slowdown in North America. And then yesterday, Amcor, in really staple sectors of the economy, such as beverages and personal care, have noticed a noticeable decline in consumer and customer demand.
Yeah, and I think corporate travel management also said something similar today also. Tomorrow, federal election. Any importance for markets? Because it seems like both parties are going on a bit of a spending spree.
Well, when you contrast to what is happening with global tariffs, the unpicking of the trade system, which has been part of the world for the last 80 years, what's going on geopolitically in Europe and in the Middle East, I think the Australian federal election is a very benign item that the market is dealing with. Certainly, Australia is well positioned vis-a-vis the rest of the world in terms of we actually at a federal level have very low debt levels relative to the rest of the world, and that is giving both parties the capacity to spend more. I think what the market would be concerned would be if it's not a clear result that a minority government has to then negotiate with the minor parties or with the Teals. That would be concerning because just the level of uncertainty around future legislation. But if it's a clear result, then I think that the markets will absolutely take it in its stride.
I'm keen to get your take on how the consumer is feeling at the moment, because we saw some stats from the ABS that show that retail sales rose a less than expected 0.3% in March. But whilst retail sales turnover is rising, volumes have stayed the same. So they're not necessarily buying more things, right? What do you think this says about the consumer? And more importantly, what does it mean for the outlook for interest rates?
Yeah, a few things. I mean, I think the number was a slight miss. It's still positive, and consumer spending is still growing at over 4% per annum. There's no doubt that the consumer is more cautious, that the emphasis on growth has been in more those stable categories such as supermarkets and groceries. And that makes sense that consumers are more cautious and they're spending more on those sort of staple at-home types of items. In terms of interest rates, I think there's several indicators that the Reserve Bank will be looking at. Primarily, obviously, the inflation rate, that core rate was now under 3%. It's in that target range of 2 to 3%. The retail sales are stable, but they're certainly not robust. And the final element which the Reserve Bank will be looking at would be obviously the employment statistics. But I think they'll have solace in terms of the direction of inflation. It has come back to their target range. And so then I think that raises a very high probability that they'll be able to cut interest rates by 0.25% when they meet in May.
And finally, given we are still in a relatively volatile economic environment and a market environment, what are you telling your clients at the moment? And are there any opportunities for them?
Well, I think markets have actually got ahead of themselves in terms of this recovery, because the outlook for global economic growth and corporate earnings is definitely more depressed than it was 6 to 8 weeks ago. But markets, both the ASX and the S&P 500, are trading at a premium to where they were historically. And so in that sense, I think that markets look a touch overvalued at this point. And I think the emphasis at looking at more domestic-oriented companies, Australian companies, whether it be Woolworths or Coles or Wesfarmers, they are far better cushioned to absorb any of the downturn that maybe some of the materials or the energy companies are facing, particularly those companies that will be affected directly by tariffs. So cautious at this point in time, but I think clients are looking to buy back into the market, but on these big drawdowns that we've seen more recently. And I think volatility will certainly stay with us for the foreseeable future.
It's Marcus Bogdan there, the Chief Investment Officer at Blackmore Capital. That ends the week for this SBS On The Money podcast. Don't forget to give a rating or a review on Apple Podcasts or Spotify, and to click subscribe.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.